My name is Andrew Stonson. I want to welcome you to this Valuation Master Class presentation. Nvidia's earnings just came out, and they just blew away, what expectations were. Things have been growing crazy in the tech sector, and today we're going to be listening to one of the Valuation Masterclass Professional student presentation. When I say Valuation Masterclass Professional, that means that this student has spent about 300 to 500 hours perfecting their skills, having valued about 11 companies and gotten feedback in all those to build their strength. And now the final project is Nvidia. So without further ado, let's bring her in. Hold on. Kalthar, how are you?
I'm fine, thank you, Andrew. How are you?
I am excellent. And, I was just saying it's a great time right now to hear your report because, Nvidia's just reported and, it's such a challenge with the tech sector, flying as it has. So without spending a lot of time before we go into it, I think we just need to start. So I've got your screen up here, and I'm just going to now leave the screen. And then when I leave, why don't you just start, okay?
All right.
Okay, I'm leaving now.
I initiate coverage on Nvidia with a buy recommendation based on a target price of $290, implying an upside of 107%. I derived my target price from a DCF-based valuation using a WACC of 11.3% and a terminal growth rate of 3%. Now I have three strong factors here that drive my recommendation. The first is that Nvidia's innovative products are likely to squeeze out the margins of competitors. The second is that Nvidia will benefit from DeepSeek's AI market disruption long term. And the third is that despite its size, Nvidia is far from maturity with strong profit and continuous innovation. My name is Kalthar Rufai, and next I'll be introducing you to the company and telling you why now is the best time to act to capture that 107% upside. Now, before I go into my drivers, let's talk about the company. Nvidia Corporation was founded in 1993 and is a global leader in AI and computing. It's based in California in the USA and derives revenue from multiple countries, with the USA accounting for majority share. Its main revenue source really is the sale of GPUs, which are used for gaming, in professional markets, data centers, and for AI technologies. Now, Nvidia has captured about 88% market share in discrete GPUs, underscoring its dominant market position. But what even are GPUs? Think of them as powerhouses. And so our PCs, gaming systems, and even the AI we use today, like the common ChatGPT, these technologies require GPUs to drive them. And so we can say that GPUs are necessary in the supply chain for many of the technologies that we use today. To sustain its growth, Nvidia recently invested in a $500 million innovation hub in Silicon Valley. And of course, this underscores its commitment to continuous innovation and expansion. Now let's get into my drivers. Why do I believe that Nvidia is a buy? My first point here is that Nvidia's innovative products are likely to squeeze out the margins of competitors. Now, did you know that as of January 2014, Nvidia's stock price Nvidia traded at 50 cents. 10 years later, its stock traded at about 145 US dollars as an early January 2025. Now, this represents an almost 30,000% return. To put this in context, if you had invested about $10,000 in Nvidia in 2014, you would have about $3 million now. Isn't that mind-blowing? Nvidia experienced a 126% year-on-year revenue growth in 2024, and this was especially due to high demand for its GPUs. Now, Nvidia has announced to release its new GPU series in 2025. It's known as the RTX 50 series GPU. Now, this product boasts of a performance 3 times that of its previous generation, and Nvidia has announced to sell it at 1/3 the price. So 3 times performance at 1/3 the price. And of course, this would indeed frustrate the margins of its competitors and of course frustrate their products. Nvidia, however, has more costly in-demand products that would compensate for its own stable margins. My second driver here is that Nvidia will benefit from DeepSeek's AI market disruption long term. Now, a Chinese company, DeepSeek, released its I1 model just recently in January 2025. Now, this AI tool is confirmed to be at least on par or even better than many of the best US models that we know today, such as the ChatGPT, the GPT, and even Gemini. Now, what is interesting is that DeepSeek trained this model with just $6 million, which represents about 2.5% of the amount that it costs OpenAI to train its GPT-4. Furthermore, DeepSeek's model was trained using Nvidia's H800 GPUs, which were actually built with reduced capabilities and have now even been banned in the USA. Interestingly as well, DeepSeek's model requires significantly less amount of GPUs than the models that we use today. Now, how does this affect Nvidia? Nvidia's stock price plunged significantly after this news was released. And this is because the market knows that developers will now realize that they can do more with less, which means that they can build similar models with less amount of GPUs and with lesser quality GPUs, so to say. But I believe the market overreacted, and I would explain this using the Jevons paradox. Now, Jevons paradox explains that when products become cheaper and more efficient, it creates widespread demand such that total spending rises, not falls. Now, think about the days of the IBM when computers were too expensive and indeed inaccessible, compared to today when we have PCs and computers are much more accessible and much cheaper. The compounded effect of that is that there is now more total spending on computers and not less, even as the price of computers fell. Where am I going with this? The barrier to entry for AI developers has been lessened. What used to be a capital requirement of hundreds of millions of dollars has been lowered to about $6 million. And so I would expect governments, corporations, and even individuals to begin to swarm into this AI market and begin to develop AI tools for various purposes. And I believe that long term, this will cause total spending on GPUs to rise, not fall, even as the cost of GPUs may indeed fall. And as I've explained before, NVIDIA's products are necessary in the supply chain for many of the technologies that we use today. And so if there's one company in the infotech sector that is capable enough to innovate, adapt, and benefit from this DeepSeek's AI market disruption long term, it is indeed NVIDIA. And my third driver here rather is that despite size, NVIDIA is far from maturity with strong profits and continuous innovation. Now, NVIDIA recorded revenue growth rates of 53% in 2021, 61% in 2022, and 126% in 2024. Now, these are not signs of a mature company. Mature companies don't have these kinds of rates year on year, consistently and continuously. And so this is indeed proof that NVIDIA is still a growing company with much room for growth. Furthermore, with AI applications set to surge, businesses are expected to triplicate their generative AI spending from $16 billion in 2023 to about $143 billion in 2027. Now, this boom, NVIDIA's high profitability and its innovative capabilities ensure that NVIDIA remains a crucial supplier of GPUs and indeed maintains its position as market leader. Now, let's look at the historical quarterly data. Now, FY 3Q25 is just the actual last quarter of 2024. It's just a matter of how NVIDIA records its financial statements. So these are all historicals. Now, looking at quarterly data, we see that NVIDIA recorded a 94% revenue growth rate. It saw a 95% increase in gross profit, 4% increase in net margin. And NVIDIA is able to achieve impressive results like this because its products, especially its GPUs, continue to disrupt the market and beat those of its competitors in terms of performance and price. As such, demand continues to rise. Now let's look at constraints to growth. I believe that in general, NVIDIA's constraints to growth are neutral. The only major one that I find here is in terms of operations, and that is because NVIDIA relies heavily on third-party foundries like TSMC, which is also another company for chip fabrication. And so we can think about the kinds of constraints that may pose. Aside that, in general, constraints to growth are neutral. Let's look at the revenue breakdown. Now, NVIDIA operates in two segments, computer and networking segments and graphics segments. Now, the computer and networking segment accounts for 78% revenue, and this is where its data center products, its GPUs that are used, mostly for AI purposes in data centers. They fall under computer and networking, and we see that is 78% of total revenue. NVIDIA also operates in various countries, with the USA accounting for majority share at 44%. And furthermore, NVIDIA operates in specialized markets, again with data center accounting for 78% of revenue growth. Now, what we can infer from this really is that NVIDIA benefits majorly from the AI boom and growth of AI in the tech industry. Let's look at FVMR. This is a special ASTOTS way of analyzing companies. What we see is that when NVIDIA is benchmarked against 1,790 non-financial companies in the USA, it is ranked top 10%. In fact, the only cause for concern here is in terms of risk at the bottom corner, which is ranked bottom 10%. And this is because the stock is extremely volatile. Nvidia stock trades at a beta of 2.7. It is extremely volatile. But you see, this is not so rare to find for super normally growing companies. You would tend to find that they have exceptionally high volatility, and so that is a major risk. Aside that, in general, Nvidia is ranked top 10% when compared to 1,790 non-financial companies in the USA. Let's look at quarters 5 forces. I assigned it an overall score of 71%. That is because I view the business model as rather stable. The major cause for concern here is in terms of bargaining power of suppliers, and that is because Nvidia relies on suppliers like TSMC and indeed Samsung for semiconductor manufacturing, and this of course gives these suppliers strong control over essential inputs. Aside that, I think the company has quite strong business model. Let's look at leadership. The president and CEO is Jensen Huang, and interestingly, for the first time, I'm seeing that the company does not have a chairman. What it does have is a lead director who is an independent board member. And his role is to ensure and protect the independence of the board. And you would find lead directors in companies where the CEO has significant influence, but they do not have a chairman. Let's look at top shareholders. We have Vanguard, BlackRock, FMR, State Street Corp, and Jensen Huang, the CEO himself. And these 5 top shareholders make up 29% of the total shareholding of Nvidia. WCB, world-class benchmarking. This is another special A-Stocks way of analyzing companies. Now, the reason for analyzing it this way is because some companies are profitable but are not growing, and some are growing but are not profitable. So we want to see, does this company have profitable growth? This time, Nvidia is benchmarked against 620 large infotech companies globally. And what we find is that for years now, really, Nvidia has been ranked top 10%, which means the company is both profitable and growing. And these are just some ways to explain the WCB. Let's look at ESG. I think the company meets expectation when it comes to ESG. Major concern really was with governance, and that is because the company has been associated with some controversies regarding insider dealings. But it's worthy to note that this was, way back in 2001, but it remains, a challenge. Aside that, the company meets expectation when it comes to ESG. Now let's look at my forecast. What we see is that I grew revenue very slowly compared to how it has been growing. But I did lower margins, and that's why we see that cost of goods rising beyond what they used to be. And that is because I'm not oblivious to, the disruption that DeepSeek has caused and how, that may pose some efficiency challenges or, just some challenges when it comes to producing now. And of course, it would also lower, I would expect GPUs, the price to also be lowered. And so, that would just lower their margins altogether. And so I have factored that into my forecast. And if you look down towards net profit, you will see that I significantly dropped net profits from about $30 billion in 2024 to about $18 billion in 2025. And that's because if you look at 2023 versus 2024, you see that 2024 was an exceptional year. But, now with DeepSeek, I expect things to not continue to grow to infinity, at such an extent. So I did drop profits and I did drop margins. But what we still find is that despite me doing this, Nvidia is still a buy. These are just some more numbers. Yeah, this is what I was saying, that I dropped gross profit margin. So if you look at 2024, you will see that the gross profit margin there was 74%, but I did drop margins to about 60%, and I derived this value looking at the historical margins and also just understanding, the challenges and the possibilities that DeepSeek may cause for Nvidia, and just the fact that prices may be lowered and so margins may also be lowered. And let me just reiterate that despite this, Nvidia is still a buy. So let's look at relative valuation. So when we look at the PB to ROE multiple, we see that Nvidia indeed trades on a very high multiple. So we can say that by this metric, Nvidia is an expensive stock. If you look at the PE to growth multiple as well, the same thing. Nvidia is expensive, trades at a significant premium. But what I would say is that this relative valuation compares Nvidia to the infotech sector, in Asia, in the USA, and the world. And many of the companies that you would find in this basket are not as large as Nvidia, and so I think that generally you can expect some premium on the stock, and I think the market is aware of this premium. Now let's go into my absolute valuation. I forecasted and I valued using the free cash flow to firm method. I assume a risk-free rate of 4%, given the current interest rate fall and also, the U.S. Federal government bonds. I also assigned it a market equity risk premium of 7%. It's a high beta stock really, so I assigned it a beta of 1.3, resulting in a cost of equity of about 13%. I then forecasted a capital structure with an 18% debt to total capital, and this results in a WACC and discount rate of 11.3%. I then use a terminal growth rate of 3%, of course, using the free cash flow to firm method. And this, generates a value and a target price of 290 US dollars based on the free cash flow to firm methodology, implying a 107% upside. Now let's look at the sensitivity analysis. When we look towards the free cash flow to firm and free cash flow to equity methods, across base case, pessimistic case, optimistic case, all the target prices that we find are significantly larger than the current price for this model, which is about 140 US dollars. And so by my valuation and by my forecast, Nvidia is a buy in any case. Finally, let's look at the risks. My biggest risk here is a failure to innovate and evolve, because a lot of my assumptions are hinged on the fact that Nvidia would continue to innovate and indeed beat its competitors like it has been doing. An inability to do that would indeed render a lot of my assumptions inappropriate. Second risk here is that it has limited number of partners and distributors. Nvidia, it mostly sells to distributors who then go on to sell to others. And so in that sense, it has a limited number of partners and distributors. And we also have, dependence on third-party suppliers. And the fact that, it may have majority market share, but some of its competitors are still very strong, like AMD. And we have come to the end of this presentation. I hope I've been able to explain why now is the best time to capture that 107%, especially as the stock price is currently down. As we know that when stock prices are down, that is the best time to enter for any high growth stock. Thank you.
Well done. Man, is that interesting. Let's go back. I need you to share your screen because I want to look at the free cash flow. So you can share that again. Hold
on. Can you see?
Not yet. I think you stopped sharing. Try to see if you can share again.
Yeah, 1 second. Now?
Let's see. Nope, I don't see it. Okay. Well, we can go without it, but let's go through some questions. The first one is, I'm just trying to understand. Okay, hold on. Maybe we got it now. Hold on. Okay. Yeah. Yeah. So just go to the free cash flow.
Yeah.
Okay. I'm going to just blow that up so we can all see that. So here we can see the cash NOPAT, 20 billion up to 29 billion.
Yeah.
Working capital is a small element, and CapEx is relatively small. So you end up with, let's say cash NOPAT of 20 billion and free cash flow of 15 billion. Why is CapEx so small compared to NOPAT? You would think that there's a lot more CapEx for this business.
Yeah, so I think really it's just about how they operate. So if you look at it historically as well, you would see that they have low CapEx, but they have high, cash NOPAT. So really it's just a matter of how they operate. I think they are not such a heavy instruments company as they are a profitable company. So just looking at how they operate, that's how the company works.
Okay. And I was going to say, what's the risk that you're overly optimistic because 2024 was so good, but I can see, as you've mentioned, that you're being conservative in your forecasts.
Yes.
Now, somebody could say, well, look, it was 9 billion, let's say, in cash NOPAT in 2023. So even 20 billion maybe not compensating for a potential fall from where things were 32 in 2024. I'm just curious, would you say that this is conservative? Would you say that this is realistic?
Yeah, I would say it's conservative because, dropping cash NOPAT by $12 billion is indeed a lot, maybe even too much. I think, looking back towards 2023, too much might be underselling the company because the company has grown. There's no doubt about that. So we can't exactly look back beyond 2024 so much and say, no, the company is going to go back to 2023. No, it's a new era. And so I did drop it because of DeepSeek, but I don't think it's going to drop to the extent that it did before 2024.
Okay, let's go to your gross margin up a couple slides.
Okay.
There, go down. Let's just look at the gross margin.
Okay, sorry. 1 second. Okay.
Okay. So one of the questions that came in from Habidat says, if GPU prices are lower, why is cost of goods increased? But I guess that maybe maybe you could mention like what's happening with GPU prices and how does that impact gross margin?
Okay. So generally, when margins are dropped, cost of goods sold would increase relative to revenue. And why that is because, like I mentioned, by itself, it had already announced to sell its GPUs three times the price, one third the price rather, for a GPU that has three times the performance of the previous. And so what that means is that the margin, the difference between the price and the cost shrinks. And so the margin shrinks and the cost of goods sold increases relative to that revenue. It's almost as if Nvidia predicted DeepSeek because it came out on its own even before DeepSeek announced and said, "Oh, I'm going to drop the price of my GPUs." And so, that of course would drop margins and then cost of goods sold would rise relative to revenue.
I haven't spent time looking at DeepSeek, and but one of the questions is that if the AI boom continues to be very energy intensive, that could be a constraint, right? That eventually it becomes pretty expensive to create and run these, AI systems. But you mentioned that DeepSeek is, using a much lower level of energy. I'm just wondering if you've thought anything about that, the concept of energy and the role of energy in the spread of AI.
Yeah, well, given that this is about Nvidia, I think the major cause of concern really is the the effects that DeepSeek would have on Nvidia, and that has been made clear in that Nvidia spent way less on GPUs, used way less amount of GPUs, and so what that means is that the capex that companies, AI developers would spend on GPUs is bound to reduce over time. And what that means for any GPU producer really is that their prices would fall. And that is why I'm saying that the price of GPUs may fall. It's not really an issue of energy. It's really an issue of, what is happening with GPUs for AI developers.
So how does it feel to graduate from the Valuation Master Class?
It feels surreal. I almost can't believe it. I was extremely tired. At a point, I was waking up, to tell myself, "You can do it. You can do it, Kauthar. You do not fail," because you call it the world's toughest valuation course, and in fact, I indeed I agree. It's severely difficult. You value about 10 to 11 companies. You review the valuations of others. You value a company. You have to go back and go back and go back. You write reports. You submit projects. It's a lot, but I think it has been very rewarding. It has boosted my confidence when it comes to valuation, and I am incredibly proud of myself. I'm grateful to you that I've completed this.
Yeah, well, you did a great job on your presentation from boot camp, and now you've done a great job on the graduation from Valuation Master Class Professional, the full Valuation Master Class. I'm just curious, you were feeling really high and great and confident when you presented for boot camp. What's the difference for those people that are taking boot camp and not sure about, what am I going to get from professional? How would you describe the difference between what you're doing now versus what you did then?
Okay, so in the boot camp, I entirely valued just one company. In professional, I valued about 9 to 10 more. So you would imagine how much more expertise that gives you, how much more confidence. When you value many companies, you come across some different scenarios, different problems that you didn't know would exist. You thought you knew it all when you just valued one, but when you keep valuing companies in different sectors, indeed, you learn different things. You would see a company that has greater depreciation than capex, and that distorts your DCF, and you're wondering, how does this happen? And so I think there's a stark difference between graduating from the boot camp and graduating from professional. And I think professional forces you to be a professional, really, because you also, not only do you value and people review yours, you also review others. And so it's a great process. And I think it's a great difference. And I think anybody that graduates from the boot camp should strive to graduate from professional as well, if you really want to develop expertise in valuation.
Yeah, one of the things that's challenging is that when I write the tagline for the Valuation Masterclass, I talk about, becoming a valuation expert, a master, or something like that. Let's say a valuation expert in months rather than years. And
Yeah.
sometimes it seems a little, is somebody that's worked on this for months really a master, an expert? Well, no, you can say there's a lot more that they've got to learn, but when you compare what you just went through compared to all your peers, even compared to me when I started my career, I didn't value 9 companies until, a couple years basically to get to that point. But I'm curious, like how when I think about the tagline I use, become a valuation expert in months rather than years. Is it true? Is it overstretching it? What do you think?
I think it's true. I think it's true. And that is because in fact, I don't know how to prove that this course is intense. It is difficult, it's intense. Sometimes I thought, I'm working more than what I'm doing more than what investment bankers do. I'm doing more than what analysts do in actual firms. It's intense. Sometimes you're giving like 2, 3 days, sometimes even 1.5, days to value a company. And then it really tests your grit, your commitment, your expertise, your problem solving skills. And I think anybody that has valued 11 companies, 10, 11 companies, and has had these valuations reviewed by professionals, and has gone back to a date and a date until they're seamless, and has done that for about 11 companies in various industries. I think anybody that has truly done that has, developed expertise in valuation.
Yeah, and I would say that they've also experienced majority of the problems and challenges that they're going to face, and
Yes.
now they got a handle on it. All right, we got to wrap this up, but wow, that was amazing. I'm so proud of you, and you've stuck with it to the end, even though I know it pushed you to your limits. But I'm here to bring transformation to people's lives, and I hope that you felt that.
I did. Thank you
Yep.
very
All
much.
right. We will be in touch more later, but I just want to say thanks. Congratulations. That was awesome. I'm going to take you out now. Talk soon. Incredible. What a great presentation. We did get a question from Habibat, who says, how long does the program take? Well, Valuation Masterclass Bootcamp takes 6 weeks. So if you want to take that, feel free to go to valuationmasterclass.com. You can also scan the QR code that I show there. Just go to valuationmasterclass.com/bootcamp, and you can learn how to become